Good morning, everybody, and welcome to MarketStream.live. This is What's Hot on the Open, and my name is Joseph Kizik with the Kizik Group Securities offered by MoneyBlock. This is where I give you my unique perspective on what's going on with the markets, give you some context, utilize different approaches that I'm going to tell you right now you're not going to see on major media outlets that'll give you context on your investment portfolio. Let's just jump in because, as we noted last night in the closing bell, we had some big announcements this morning on earnings. We had the big banks. And I tell you, I said, watch Jamie Dimon's comments, and I didn't expect what he actually said on the call. But the major banks reported they had some decent earnings. Now, they're lowering their forecast, but Jamie Dimon, the head of JP Morgan Chase, interesting comments about Washington. You should go back and take a look, but he's definitely not happy with our elected officials, and nor should any of us. I think this isn't, well, let's just say, for lack of a better term, a joke on how both our local as well as our national politicians are running this country. But this is not a political show. This is where we look at the markets and look for opportunities, give perspective. I want to take a look at the index, though, that does measure fear. The VIX. The VIX is not moving this morning, even though we have the financials under pressure today, and we'll get into that in a minute. The volatility index isn't moving. Now, there's a lot of reasons that we've discussed in past shows, so you can go back and take a look at our archives where we discuss what's going on with the markets and why volatility hasn't reared its head. But the bottom line is, it hasn't. That doesn't mean that volatility can't be out on the horizon. What it means is right here and now, and based on the models that we've used to forecast implied volatility and potential movement in the underlying, it's not forecasting it at this juncture, at least not in terms of the S&P 500, which is what the VIX is priced off of. Now, taking a look at the Dow Jones, a little bit of a mixed bag this morning. The Dow has been holding up, now trading at its best levels right now of the session, up small, and we're seeing that the markets are firming up now after the open. But you see that the Dow Jones is up 19. Taking a look at the S&P 500, you continue to see that it's holding up, and that's despite the fact that we've had some weakness in the financials. We'll touch on that in a moment, as well as the NASDAQ. Now, the NASDAQ has been the most volatile index out of all of the three major large cap indices. Tech has been on the move. As a matter of fact, I use this term implied volatility a lot so far this morning, and I use this as a barometer of not only expectation of potential move in the markets, but it also helps me understand, am I deploying the appropriate strategies in my portfolio? Not just asset classes, but strategies. And right now, if you had exposure to tech, you've had some good, decent sized moves, both to the upside and the downside. It has statistically gone outside of its, if you look at a bell-shaped curve, out of its one standard deviation range. Technically, it's only supposed to go out of there about 16% of the time. Well, it's actually doing that about 25 to almost 40% of the time this year. It's a significant number, folks, when you see that it's actually going outside of what its expected move range is over the course of the year. And that's just looking at the first 6 months of this year. So that's just showing you that there is potential for volatility. You can see in the chart right here that the NASDAQ is getting more and more volatile. We've noted that over the last couple of weeks when we stated that the implied volatility rank of the NASDAQ and the tech sector in general, but specifically the NASDAQ, has been at around 50, which means that it's prone for moves like what we see here, and a gap here. You're seeing that there are those moves. That's the movement in Facebook, Apple, Amazon, Netflix, Google. You're seeing it all over the map, and it's being represented in that implied volatility rank, which is around 50. That's what we use to rank whether volatility is high, moderate, or low. High being above 60, 70, low, moderate being around 40, 50, and low being 30 or lower. Now, taking a look at the small caps. Small caps have been holding up quite well this morning, despite of the fact that we had, again, pressure in the financials. And we had PNC announce decent earnings. We'll take a look at the stock in a minute, but you can clearly see that the market has been holding up. And this is where I watch. The 20 and 50-day moving averages are things that I utilize for support or resistance. If the market is trading above these lines, that is acting as support. If the market is trading below these lines, that means that it's potential resistance. It also gives me an idea, is there a sentiment shift in the making? If there is, then I look at my portfolio and see where my potential risk factor is. That's all I use this for, perspective. Nothing more, nothing less. Taking a look at crude, crude has basically firmed up at these levels. Was testing the downside earlier in the session, but it's now in that battle zone for crude bulls. It's going to have to get over this 50-day moving average at 46.57 on the crude contract. If it gets over that and stays over that, which it just did right now, this is going to be significant for the bulls. That means that they could have a catalyst. Again, there was some decent reports out this week on a draw from the storage, both in oil, gas, and distillates. So, but we're seeing some mixed data that's coming out. Specifically, we saw, as a matter of fact, retail sales come out, which is why it's surprising that the oil number, it's firming up here. It's not completely solid. We're going to see where it closes. But we had retail sales numbers come out, and the May sales were lower, and you're seeing increasing inventories as well. Is the consumer cooling off? Now, traditionally, May, June, July tend to be periods in the retail area where you're going to have a little bit of a lull. But we're going to watch that very closely, because now we're getting into the tail end, getting into that late July, early August, back to school, things of that nature. Watch this very closely. What has rebounded really nice this morning is gold. You can see that it's up $11. That's good for almost over 0.9%, and it's now challenging that 1234 level. That's a level that it's going to have to break if it's going to try to catalyze for any upside move in the shiny metal. What's also had a decent move this morning is copper. Bounced off of its lows where it settled last night, trading at 268. This non-ferrous metal that is a good barometer, folks, for institutional and material sectors. You need to see this thing up at this 268, 270, 272 level to have some conviction. And there is frustration on that infrastructure play that everyone is waiting for, some sort of plan from the administration. Taking a look at bonds, bonds firmed up. Bonds looked weak towards the tail end of yesterday and most of yesterday. They bounced on the open, but they've come off of their best levels. They cannot get through that 50-day moving average, which is represented by this red line. You're going to watch TLT 124.10. That's the level. If it's going to resume any upside price action in bonds with some conviction, it's got to get above that level on TLT. You're also seeing similar action in the 2-year, the 10-year, and the 30-year, all challenging that 50-day moving average but pulling back. That means that any bond bulls, as far as price action is concerned, in other words, you think that the prices of the bonds are going to go up, yields are going to go down, they need to get through these levels if they're going to have any conviction for any potential further upside move. Just globally speaking, because I was very busy this morning, so I apologize. I wasn't able to do the European and the Asian wrap up. I'll do something this afternoon. But taking a look at Europe, you can see that Europe right now is a little bit of a mixed bag. You have FEZ, which takes a look at the 50 largest cap stocks in Europe, trading up now in nickel and above its 20-day moving average. But you are starting to see the UK as well as France struggling right now, right around its 20 and 50-day moving average. And then you also have Germany looking to challenge and potentially challenge the 20-day moving average going into the close. They'll be closed at noon Eastern time. So we'll watch these very closely. Watch EWG for Germany, EWQ for France, and EWU for Great Britain. These are all trading in green territory right now. Here, the ETFs that are tracking these indices into the U.S. And we're also seeing the bond markets trading mixed as well. The British 10-year down, France and Germany up. Very interesting action. And then we had some decent action that continues in the emerging markets in Asia. The Nikkei finished up 19, basically a flat week, but watch the yen. The yen has strengthened up here, and that is not what the Japanese want. They do not want a strong yen, and that's something that you're going to want to watch. Watch the currency markets. That could be a little bit of an area where you can get a flag. If they start to see global currencies firm up, especially against the US dollar, that could put some pressure on global markets, and that could put potential pressure or potential volatility globally as well. All right, folks, we've covered a lot so far. We're going to be back on It's Strategy Now. I'm going to be talking about some cool strategies and looking out at some earnings plays next week. So please join us at 1:30 Eastern, 12:30 Central Time here at MarketStream.live. See you then.